All right, let's talk about Inuvo. This is an ad tech company that just saw its stock get hammered, dropping 17% after what, on the surface, looked like a really bad Q3 earnings report. But here's where it gets interesting. Management is out there saying, hey, this was supposed to happen. They're claiming they intentionally took a hit this quarter for a bigger payoff down the road.
So that's the big question we're going to tackle today. Is this really a calculated risk? Are they taking one step back to take two giant leaps forward? Or is this just the beginning of some real trouble for the company? We're going to dig into the numbers, look at what management said, and see if their story actually holds up against what the market is clearly screaming.
Okay, so here's how we're going to break it all down. First, we'll look at the Q3 scorecard, the hard numbers. Then we'll get into management's deliberate pivot. After that, the market's verdict, which was pretty harsh. We'll weigh the catalysts and the crossroads for the company, and then we'll wrap it up with our take, the next call.
All right, let's kick things off with the Q3 scorecard. And look, there's no way to sugarcoat this. The numbers were a clear miss.
So revenue landed at $22.6 million. On one hand, that's pretty much flat compared to last year. But here's the kicker. It missed what Wall Street was expecting by about $3.3 million. That's a 13% miss. And in a space like ad tech where everyone's looking for growth, flat is basically going backward.
And things didn't look any better when you moved down to the bottom line. The loss per share came in at negative 12 cents. The street was only expecting an 8-cent loss, so they missed that by 4 cents. It just shows that the pressure on profitability is really starting to build.
Okay, this table really puts it all into perspective. You can see the revenue miss and the EPS miss right there, but honestly, the thing that should make you sit up and take notice is that gross margin number. Look at that. It cratered from 88.4% last year all the way down to 73.4%. I mean, that is a massive, massive 1,500 basis point drop. It's no wonder the adjusted EBITDA loss got worse. This was just a financially brutal quarter, plain and simple.
So you see numbers like that, and you've got to ask, how on earth does management spin this? Well, their story is that this wasn't a mistake. They're arguing it was a deliberate choice, a strategic pivot. Basically, they're saying we wounded ourselves on purpose, but it was for a good reason.
And here's the line directly from the CEO, Richard Howe. He's saying this wasn't about demand drying up. He claims it was about getting their house in order to handle more demand later. Essentially, the story is they hit the pause button with their biggest client in the middle of August. Why? To push through a big system and compliance upgrade that they say was absolutely necessary to grow that relationship in the future.
So let's break down this pivot into 3 key steps. First, like we said, they paused their largest client to do this big upgrade. Second, they rolled out a new AI system they're calling Ranger. The whole point of Ranger is to make sure their ads are compliant, which helps de-risk the whole operation. And third, they're changing their whole sales focus. They brought in a new COO, Rob Buchner, and his job is to go after the big fish. We're talking larger, multi-million-dollar deals directly with brands. The end game here is to build a business with higher quality, more predictable revenue.
Okay, so that's the story from management. Short-term pain for long-term gain. It sounds pretty reasonable, right? Well, the market heard that story and said, nope, not buying it. The reaction was immediate and it was brutal.
And I mean, just look at the damage. The stock opened around $3, and just 2 days later, it was trading below $2.50. It got crushed, dropping over 9% on the day of the announcement, and then it just kept on falling. We're talking a 17% wipeout in 48 hours. That's millions in market cap gone, and it's a huge vote of no confidence from investors.
And this wasn't some quiet little sell-off either. Look at the trading volume. It more than doubled its recent average. That tells you people were selling with conviction. They heard the explanation from the company, and they basically ran for the exits.
So this all leads to a classic standoff, doesn't it? We're at a crossroads here. You've got a really compelling bull case and an equally scary bear case. Let's weigh them against each other.
And this really lays out that tug of war. If you're a bear, you're looking at this and thinking, okay, can they actually pull off this new strategy? And look at their cash position, only $3.4 million. That is razor thin. Plus, those margins are still a huge problem. But if you're a bull, you're looking past that. You're focused on the huge catalysts coming up. There's a potential multi-million-dollar government deal in the works. There's a big lawsuit payout they're expecting in early 2026. And you believe their new tech is going to land them those bigger, high-margin clients. It's a classic battle.
Okay, time to put all the pieces together. Let's figure out what this all means and make our final call on where this stock could be headed.
So here's our prediction. We actually think revenue growth will return in the fourth quarter.
Management guided for a comeback, and with that big client back in the mix, they should be able to hit that top-line number. But that's not what investors will be watching. The focus is going to shift completely. It's not about growth anymore, it's about profitable growth. The market is going to want to see those margins stabilize and see them get a handle on how much cash they're burning through.
So how would you play this? Well, it's a speculative rebound trade for sure. You're basically betting that a strong Q4 number will catch the market off guard and cause a pop in the stock. But you have to be so careful here. The balance sheet risk is real, so you'd need to go in with very tight stops. One more piece of bad news, and this thing could really fall apart.
Taking everything into account, we're landing on a market perform rating. Look, the long-term story here, with their cool AI tech, is genuinely compelling. But you just can't ignore the very real risks they're facing right now with their finances and their ability to execute this new plan. Until they can actually prove that this big pivot is working and leading to profitable growth, we think the stock is pretty fairly valued right where it is. The risks and potential rewards feel pretty balanced for now.
And as always, just a quick reminder that this is for informational purposes only. It is not financial advice.